We love real estate investing. I think most Australians love the idea of building a real estate portfolio. I just want to touch on a few things about real estate that I love, what I think maybe some people don't have a full understanding of. That's incredibly powerful when you're looking to scale out a portfolio. And not that other asset classes are bad. I actually think you should be really diversified in your assets that you purchase, unless you're a serious specialist and going all in on something. But there's some real power when it comes to real estate investing. One of those is the obvious, it's leverage. You can buy a $500,000 asset with roughly $130,000 being a 20% deposit and closing costs. There's not many other asset classes out there that you can actually do that. Whenever I invest, I actually take quite a conservative approach. I'm someone who will buy and hold forever and ideally have that debt paid off over time. But in between now and when that actually occurs, there are a number of things that if you buy right, give you huge advantages. One is obviously the leverage. The other one is actually amortization of that leverage. So amortization is really a fancy word for debt reduction. So depending who you speak to, some investors will say always go interest only. I like to also mitigate risk. We never know what's going to happen in the future. We can only look at what's happened in the past. So one way to mitigate that risk is through actually debt reduction, which creates equity over the long term and can reduce your risk to debt exposure. So if you've bought right, your tenants will actually cover the cost of your holding costs, being interest, rates, insurances, etc., and start to pay a portion of that debt down. So let's use that asset example of $500,000. You've borrowed $400,000 to buy that asset. If your tenant is able to cover those costs and over time pay off that principal, then that is a remarkable outcome because you've bought an asset that someone else pays off for you and your debt eliminates over time without you needing to chip in extra dollars. So that's called amortization. My portfolio does that. We now have a gross yield over time of roughly 12% on that portfolio. The other thing is depreciation. So when you look at real estate, it's the land that really increases in value and the property itself depreciates in value. So the tax laws currently here in Australia allows you to depreciate the building costs and the fixtures and fittings against any income from the property, or depending how you've bought that entity, the income within that entity, whether it's your personal name, trust, or company. So how that may work, really simple terms, let's say the build is worth $100,000. Our government allows you to depreciate that at 2.5% over 30 or 40 years. So that's $2,500 a year, depending on the age of the property. That $2,500 a year per $100,000 of build cost actually adds up quite a bit to help you hold and retain those properties to make sure it's cash flow positive, to amortize the debt, and to grow your wealth. So it's like a phantom loss. It's important to understand the tax laws though if you do sell that asset, and you may need to repay some of that depreciation that you received along the way. That's something you need to speak to your accountant about, but very, very, very powerful. So we have leverage, we have amortization, we have depreciation, and then we have appreciation. The appreciation of the asset and what really creates true value over time and what creates your wealth. Income from real estate, there's much better asset classes out there than real estate to generate an income. What it does do though, from a real estate aspect, once you're in that season to generate an income, it's steady, it's reliable, and it's very predictable. But wealth is created through the growth of the asset. So if you've bought in the right locations, don't just hotspot, buy in areas that are proven to have continued population growth, continued employment growth, you're going to get natural appreciation of that asset. That's going to be through inflation and through demand based on buying in the right area and people wanting to move to that specific location. So over time, that demand, that appreciation compounds to where you've got an asset that you may have bought for $500,000, 10, 12, 15 years down the track. It's doubled, it's worth $1 million, but all it's actually cost you to get into it was your original $130,000. So that's the real power I see in real estate investing. To cover that off again, you have leverage, you have depreciation of the asset, you have amortization of the debt, and then you have appreciation of the real estate held long-term over time. One really important thing I think to mention as well is And this is where I see so many people forget. In real estate, you're actually in business. Your customer is your tenant. So to be a successful real estate investor, you need to make sure you manage your tenants very, very well, because they are your end customer. They're the ones who are living in your property, taking care of your property. So you need to make sure you take great care of your tenants, because they're the ones you're really providing accommodation for, and they're the people you're serving. If you get great tenants, you manage great tenants, you'll generally have a much better experience as a real estate investor.